The rat is the smallest among the 12 zodiac animals, but don't write it off. This little fellow has been turned into some very famous cartoon characters, including Mickey and Minnie Mouse and Jerry in Tom and Jerry. And why? It's because of some of its unique characteristics. And it seems the rat can show us a thing or two about investing as well.
The rat knows how to navigate, is very adaptable to new environments, and we are at the cusp of big changes taking place in the world on the technological front, in terms of climate change. And so, it heralds a new period of opportunities and, that investors can capitalize on.
But that doesn't mean investors should ignore the traditional asset classes, says OCBC.
The equity space, Asia is going through several changes and is poised to emerge on a stronger footing, maybe 10, 20 years down the road. Gold has done very well in 2019. It could continue to do well in the coming years because central banks are also starting to de-dollarize.
Our little friend, the rat, is also not very ambitious. And this is actually a good investor trait.
A lot of times I find that people tend to want to project a particular kind of rate of return, or they demand it from the market. I want to make X percent, 10% from the market every year, or 20% from the market. But the market doesn't work like this. Let the market decide how much to give us at the end of the day.
But there is one trait of the rat that investors should not adopt.
If you ever see a rat, you just take a look and then they are scampered off already, right? So they're very observant. They will look out for any dangers and they will just react very fast. So as an investor, we should also learn to spot all the risks that's out there in the market. We should be aware of them and take some actions if the risk has become too high.
While we should be aware of market risks, being too responsive may result in short-termism, and we end up missing out on longer-term opportunities. Meanwhile, there are other animal behaviors playing out in the markets that investors could do well to take note of. Herd mentality is a concept in behavioral finance which refers to the tendency to conform with the views of the majority. We can see similar behavior in the animal kingdom. Goats and sheep naturally live and travel together in groups called herds to protect themselves from predators. Investors and professional fund managers alike can fall into this herd mentality.
When the majority of the market are buying, certain portfolio or certain shares, and then you just follow what they do. The fund managers sometimes may also make the investment decisions based on the similar competitors' behavior. And because sometimes they're worried that they may be very different from the others, and when they made a mistake, they could not blame other people except themselves.
Following the herd can be bad if it results in us buying high and selling low.
Sir Isaac Newton actually said this, I can calculate the motion of heavenly bodies, but I cannot calculate the madness of people. So he actually lost a lot of money in the stock market. The problem is that he got trapped in this herd instinct as well.
But the crowd may not be wrong all the time.
A lot of trends, in fact a lot of smart money, are the ones that create the herd, that create the first instinct. They are the leaders of the herd.
It's actually not about going with the herd or going against the herd. What's more important is for investors to do proper research and make informed decisions instead of blindly following others, say experts.
As long as you're buying based on fundamentals and valuations, and you know what you're getting into, you completely understand what you're getting into, I think that makes sense.
The stellar performance of Wall Street in 2019 raises the question of whether it's driven by herd mentality. Last year, US stocks clocked their best annual performance in 6 years.
We haven't really had big herd behavior yet. Right? In 2019, my own feeling is that many investors would have probably missed the boat.
But investors who've missed the boat will do well not to get too carried away this year.
Don't throw all your money into the markets at one point in time. Don't try and time the markets. Spread your investments out gradually over time. In other words, dollar cost average, because the markets are going to be very volatile.
Behavioral economists also draw reference to the ostrich to describe how some investors would behave under bad market situations. The large bird buries its head in the sand when it senses danger. So investors who suffer from the ostrich effect tend to ignore negative news, hoping it will go away.
We kind of consider it as maybe loss aversion. Okay, so loss aversion refers to an investor that feels much more painful when they lose $1 compared to when they gain $1. So when they see, the investment they have drop in value, and sometimes they were just like, okay, I don't want to look at it for a while. Okay, hopefully the price will come back.
The ostrich approach may, however, be applicable for some types of investment.
If you are investing in ETF, index funds, sure, leave it there. The market will take care of itself.
For your longer term investments, you do not want to be constantly trading. You basically incur unnecessary costs and you may miss out on opportunities, especially longer term opportunities that may play out over a period of 1 year, 2 years, or maybe even 3 years.
But there will be times when we need to cut losses and run for cover.
Acknowledging losses and taking them will actually protect your capital a lot more. In fact, your returns will go up overall.
Market experts advise investors to carve out two different investment portfolios. One portfolio is for short-term trading opportunities. Here, ostrich-like behavior is not advised, and investors will need to have stop-loss levels. The bulk of an investor's money should, however, go into their long-term portfolio. Because they're investing for the long term, investors can seek to avoid short-term noise and stay invested with this portion of their portfolio.
It doesn't mean that you just buy and hold and do nothing. You need to review it regularly, and ideally you should review it every once in 3 months, 6 months,